102 rupees. Okay, so therefore, if you had 100 rupees 5 years back, you could buy 2 liters of petrol. Today, you can buy 1 liter of petrol, which means the same 100 rupees in absolute terms is now getting you less items across the globe. So that is inflation. When your purchasing power of your rupee goes down year on year, that's basically inflation. Okay. So major reasons for inflation, one is demand pull. Demand pull is ideally when there's too much demand. India is a country with 140 crore people. So obviously there's a lot of demand. Today we are the largest population in the world. China has also got its rates way before us. Of course, our fertility rates are now below the benchmark of 2.1. We're around 1.6, 1.8 on a national average. So therefore, in the year 2055, 2060, we will see that majority of our population is beyond the age of 40, 50. Today our average population is around 28 years. But eventually in the next 10, 15, 20 years, all of us are going to be old. The younger population are going to be less. That time demands will reduce. But today we are a growing economy. Today we are the highest population. So when there is more demand of something, prices go up. Second reason is cost push. Today, for example, if in case, for when Russia and Ukraine got into a war 3 years ago, okay, oil shot up. Today, oil prices in the global market are roughly $60, $62 per barrel. But 3 years ago, it was roughly $100 per barrel. So when something like that shoots up, obviously everything in the world shoots up because everything requires to be logistically transported to different places. So when your cost goes up, all of your product pricing also goes up. At the end of the day, you're a company, we are a company. We all know that our margins are fixed. Whether we are doing a service, whether we are selling a product, if we need 20% profit, we need 20% profit. So if our cost of the goods and services or cost of accumulation goes up, obviously the price of the goods and services we provide also will go up. Okay. Third one is a built-in cost. Built-in cost is, for example, today I will tell you that there's going to be a 0% inflation in India. And if on an average, if all of you are earning roughly 50,000 rupees a month, let's say, if there is no inflation in the country, why should I give you a salary hike? Will you all be okay with it? There is no inflation. Today, whatever lifestyle you are managing, let's say you are running a house for 10,000 or 15,000 rupees a month, you are earning a 50,000 rupees. For the next 30 years, I will tell you that your lifestyle will be only 10, 15,000 rupees. No products that you're buying today is ever going to go up in price. So then why should a company give a person a hike? Correct? So then when the inbuilt cost, that is all of our hike, all of our increments, all of these things keep going up, automatically the cost also keeps going up. And this is the third reason for any kind of an inflation. Okay. There are some economies like Japan, which had a 0% inflation for the longest time. US had a 1-2% inflation for the last 10, 12 years. Only in the last 3 years, they actually shot up in inflation to about 6%, which is why even their interest rates went up to 4%. Otherwise, India is one of those developing economies where today in an SB account and an FD account, you're getting interest. If you have friends, family in the US, ask them 2 years ago, were you getting any kind of a FD interest or an SB interest in the US account? They weren't. Whether it was Bank of America, whether it was Chase Bank, they were charging you to keep money in their accounts. You would have to pay an annual fee of $50, $100 per account if you want to keep a bank account. But India is still a growing economy. To push growth, the government has to give you an interest, and majority of the growth of our companies in India goes on debt. If Adani, if Reliance, any of these guys want to build any new structure, they don't build it on the reserves. They take a loan and then they build it. Because, if you go to a bank today and take a 1 crore loan, it is your problem. If you go to a bank and take a 400 crore loan, it is the bank's problem, not your problem. Okay. So that's why major companies go to banks to, raise money. Yeah. Clear so far? Any questions? Okay. So the major financial goals for any middle class Indian today is travel. How many of you want to travel abroad every year? You have to give them a lot of things. Okay. How many of you want a bigger car, an SUV, high-end Mercedes? Okay. How many of you want to buy a first car, first bike? Any aspirations? I love this crowd. Okay, good. Okay. How many of you want your own house? Wonderful. Children's education, children's marriage. I think you're all still little way off for that. And finally, retirement. How many of you want to retire early? Yeah, fire. 1, 2, 3, 4. Yeah. Fire is financial independence, retirement early. Right. While I'm talking about retirement, I will tell you a couple of things. What is retirement? How do you define retirement? You want to retire early. How do you define retirement?
We started working 3 months ago.
And you're already thinking about retirement.
Maybe automate a lot of passive income.
Okay, so passive income beats your active income. Okay. What is your idea of retirement?
Same thing, but all the investments I make should be generating enough to like sustain my lifestyle.
Wonderful. Anybody there? What is retirement for you?
Full control of time.
Full control. Perfect. So retirement is not okay. When do you want to retire?
30.
30? You are how old now? 21, 22? 21. Okay, great. 9 more years. That's it. Okay. Anybody else? 40, 45, 50, 45? 45? Okay. So retirement is not an age as per us. Okay? Retirement is the day you cease to work for money. Okay, it can be passive income that is giving more than active income. It can be that you have enough corpus. Today, if you have a clarity in your mind that if I have 10 crores today, I can retire for the rest of my life, whether it is children goals, whether it is their marriage, whether it is, buying a new house, everything will be taken care of by that corpus. You're pretty much stopped working for money. Anything additional into the 10 crore is not going to make your life any better. Okay, because whatever you want to do, your budget is already done. So whatever further you are building is only going to be for your next generation. Okay, let's say if I want to take a foreign travel 200 days a year, there is a client who has this. He needs 60 lakhs per year only for his foreign travel. So we came up with a number that you need 30 crores. The moment he touched 30 crores, he retired. It didn't matter whether he was 45 or 49, he retired. Okay, so the day you cease to work for money is your retirement. Okay. So how do you get to that figure when you are going to reach that? That is where we come. Okay. We help you build that corpus. We tell you what is the corpus that you require. We tell you how much you need to start with. But today, if I tell you, okay, in 9 years, if you want to build a corpus of 10 or 20 crores, every month you need to start saving 1 crore. It's impossible. Not possible. So then, even though the number might be there, it's not realistic. So you have to start building up towards the number to your maximum capacity. Okay. Any questions so far? So basis and purpose of investing, okay, to outpace inflation. So today when you look at your savings and your investments, the difference is basically that whether it is beating inflation or not. How many of you have any kind of investments today, whether it's direct equity, stock market, 1, 2, 3, 4, 5, 6, pretty much everyone here. Okay. Have you tracked the investment whether it is growing more than inflation? Yes, he is. I'll be ashamed if he says that. Yes. So he is. So what is inflation in our country? The CPI numbers as per government is roughly around 4.5%. This year inflation has gone down a lot. Okay. But the realistic numbers that most of us see are around 8%. 8% is the inflation that we are going through. Because today the CPI numbers, they take majority of the 80% of the population who do not earn more than 25 or 30,000 in the country. So for them, their realistic inflation is only going to be groceries, fuel, things like this, very bare necessities. So for them, it's around 4% inflation. But for people like us who have OTT platforms, Amazon Prime, Netflix, things like that, it's usually around 8%. Okay. For a person who is in the top 1% of India, inflation for them is roughly around 12%. So if we keep a base figure of 8%, is your investments every year beating 8% is what you should look at. If it is not beating 8%, it is a saving. Your FD rates today are 6.5%. So in the last 6 months, RBI has given 3 revisions in the interest rates and fallen by 0.7%. So what was roughly 7.5% has now come down to 6.5, 6.75%. Today, if you open an FD in a nationalized bank, you will not get more than 6.75%. Okay, your SB accounts were 2.75% last year. Now it's 2.25%. So if you have money sitting in an SB account, you are not getting more than 2.25% taxable interest every year. So if you are in the 10% tax bracket, in the 2.25%, another 2% goes away for tax. So your realistic return is only 2%. Okay. So if it's not beating India's inflation, then it is not a investment, it is a saving. So what is beating what is an investment, what is beating inflation? I'll get to that. There are two kinds of inflation. One is a living expense, one is a lifestyle expense. Living expense is basically your goods and services going up every year. Lifestyle expenses 5 years ago, 10 years ago, we did not have OTT platforms. We were paying 1,000 rupees for a cable TV and every channel available was coming under it. But today we have 4 OTT platforms or 5. And we want to subscribe into everything because Game of Thrones does not come on Netflix. Something else does not come on Jio Hotstar. So we need both. So if we have that kind of a mindset, then automatically our annual cable, what we were paying 1,000 rupees went up to 3,500. So that is a lifestyle expense. Today there's a duopoly of networks. Basically, you have only Airtel and Jio. You don't have anybody else. VI, you hardly get any network. BSNL, very terrible service. So if you're only going through Airtel and Jio, last month alone, they removed their 249 plan and 299 plan, which is giving 1 GB data per month. So automatically our expenses went up. Okay. So these are all lifestyle expenses which you can not live without. It's not in our control as well. So these are two things you have to look at inflation. Achieving financial goals, and of course, as you said, substitute regular income where passive income will beat our active income. So the main definition of investment and savings, in investment, you don't, you have a defined amount to earn a return. In savings, only leftover amount post your expenses is what you do in savings. Okay, savings are usually just kept in the bank. You don't keep it anywhere else. Maybe in the bank or maybe under your mattress, but that's your savings. Nothing. Investments are where there is an active participation. It can be through direct equity. It can be through mutual funds. There's something called PMS, portfolio management schemes. These portfolio management schemes require a minimum investment of 50 lakhs. Okay. There's something called AIF, alternative investment funds, where the minimum investment is 1 crore. In an AIF, you get access to venture capital, you get startup, unlisted shares, all of these things. So every product of these investments has a different profile. So investments is usually for medium to long term, savings is only for the short term. Then investments has various asset classes, which I will also talk about. So if you're able to see the screen, there's something called an ideal cash flow. The ideal cash flow is where most of us might be doing today, including me 10 years ago. Okay. It's income minus expenses equals savings. How many of you are following this? If we are getting 50,000 and if we are spending 20,000, the remaining 30,000 is my savings. How many of you are following this? This is the cash flow that you're following today. But the ideal cash flow is going to be income minus savings equals expenses. You keep a fixed budget in your mind. You tell yourself, if I'm earning 50,000 today, I want to make sure that at least 20,000 or 25,000, 50%. All of you are young. You don't have a lot of commitments. You might be staying with your parents or in a PG or something. You might not be married. You might not have children. When such phases come, your expenses will shoot up. Today, for one individual, if you're spending 20,000, the moment you're married, it becomes 40,000. Okay. So therefore, as long as you have that, freedom, you go ahead and save as much as possible. So fix yourself a budget and say that, okay, today if I'm earning an X amount, 50% of my income is going to go towards my long-term savings. Long-term savings only. Not for short-term, not for things that you want to buy immediately. The moment you build a corpus of 3 lakhs, a new Royal Enfield releases, you want to go buy it. No, that is not savings at all. Okay. So once you do your income, you budget, you put around your savings, you start investing, and then the remaining amount is your expenses. Then comes the bigger chart under this. From the savings, you go ahead and start investing. Investments can be into short term or long term. Short term is usually anything less than 1 year, but we also say anything less than 3 years. Investments is anything more than 3 years. Okay. Then in the long term investments, you take that money and you start building your corpus. Eventually, that corpus will start generating a return which is more than your active investment, which is more than your active salary. That day, if that is going to be sustainable and it will take care of all of your retirements, then you can retire. Clear? So common money mistakes. The biggest thing is lack of financial literacy. Schools don't teach us. Parents are stuck in that generation where they're like, I want to invest into FDs. I want to invest, only into RDs. You know that it is guaranteed by the government, so nothing will happen. That is not. 3 years ago, 5 years ago, a bank called Lakshmi Vilas Bank became bankrupt. RBI guarantees only up to 5 lakhs. anything more than 5 lakhs is not guaranteed by the government. So if you have 20 lakhs sitting in an FD and tomorrow if something happens to the bank, they are liable to you only up to 5 lakhs, not more than. So therefore, you should take a decision of where you're going to start investing. If you look at the inflation in 1990 to 2000, inflation in our country was roughly around 10, 12, 15%. But FD rates back then were also around 15%. If you ask your parents in the year 2000 and everything, where were you putting your money and what was the return? They will say we were all keeping everything in an FD. We were getting 15%. That was more than enough. But today an FD has become only 6%. It is not realistic to keep it there. Okay. So the thing is, our parents' generation is stuck in a mindset regarding the product. So they feel that FD is safe. But today, back then as well, if your dads or moms have worked till the age of 30, they were able to afford a house. They were able to put 2 children in school and all. Today, by the age of 30, how many of you can buy a house? How many of you can put 2 children in a private school? Not going to, because money itself has become weaker. Okay. Till about the year 2000, whatever US had printed in terms of dollars, okay, they printed the same amount in the last 5 years, which is why technically markets have also gone up across the world in the last 5 years, because there was a huge liquidity available. Okay, but when huge liquidity is available, everything goes up, not just your income but also your expenses. Okay. Spending beyond their means is one of the biggest things that happens to today's generation. How many of you have a loan or an EMI running for anything? Nobody? Great. You're all wonderfully disciplined then. Okay. The biggest trap that happens today is people go for the next best iPhone, next best, mobile or bike or car, and they get into a debt trap. After 4 or 5 years, there will be some kind of a push from the parents or something, buy a house. Then they'll get into a home loan. A home loan is not a 3-year loan or 5 months, it's a 30-year loan. If you take it at the age of 30, you are stuck in a home loan till your retirement, basically. You cannot get out of it. If you do want to get out of it, you have to pay them a fee of pre-closure of 1-2% of the entire cost, which is a huge expense, unnecessary. Okay. So before you take any kind of a loan, ask yourself, is it necessary? Are you doing it for peer pressure, or are you doing it for your pleasure that you want that product or you want that asset? Okay. Instant gratification, that is, as soon as an iPhone releases, somebody wants to buy it, and lack of financial planning and discipline. This goes to the first point again, where schools are not teaching us how to budget, how to tax and things like this, and that is why businesses like us thrive today. The gap we have in the market. Okay. One thing I want to add on regarding your financial goals. Okay. Today, if you look at, let me go back to that slide. Yeah. Today, if you look at most of these goals, whether it's a travel, car, house, education, you can get loans for it. Okay. You can get a car loan, you can get a house loan, you can get an education loan. The one thing which is very important is retirement. Retirement is something that nobody will fund you. We are not a developed country like US. We don't have a 401k, wherein the government says that you commit to us 20-25% of your salary every month. When you retire in US, the retirement is around 65, 67. There's no particular age that they can work as long as they want. But the longer they work, the higher their 401k becomes. And then when they retire, the government gives them a monthly income out of the 401k to take care of them for the rest of their life and their spouse's life. Today, if most of us don't have that kind of a saving, and when we retire, the government is not going to give us any pension unless you're working for the government itself, where they're giving you some kind of a pension. Even then, today, if you join, the government gives only an NPS pension, and NPS is only 60%. You will get a lump sum. The remaining 40% you have to buy a private annuity. Government doesn't give you like an old pension scheme, wherein they are guaranteeing you some money for the rest of your life. Okay. So retirement, we are off to fend for ourselves. How many of you are staying with your parents today? Most of us. Okay. Are they retired? Are your parents retired? Are they still working? Most of your parents are working. You're all young, so all of them also will be working. Anybody working in a government job? Anybody's parents working in a government job? So they will be eligible for a pension. But when your parents retire, have they planned how are they, if they don't have a huge corpus to take care of them, have they planned, how are they going to retire? How are they going to earn? Or are they planning to continue to work till 65, 70, 75? The thing in our Indian culture is retirement is our children. Okay. Our retirement plan is our children. That I will retire, then my son or daughter will start earning money. They will give us a monthly income. That is most of our parents' retirement plan. But tomorrow, if most of you have children, do you want to be dependent on your children to take care of you in your old age? Morally, yes, but not financially. Okay, so that is where the trends are changing. 2 generations back, there were other joint families, so everybody were taking care of each other. Previous generation, we all become a nuclear family, wherein everybody is off to fend for ourselves, but the children are still taking care. Most of us, this generation, don't want children, or if we want to have children as well, we don't want them to take care of us for the rest of our life. We want to be financially dependent. So that is the importance that from day one, if you start focusing on retirement, when the time comes, you will be financially ready. Yes. Any questions?
We all started working 6 months back.
It's actually most of us, including you as well, we tell other of our clients from the day one that your son starts a job, son or daughter starts a job, let them start saving. It can be 500 rupees, it can be 1,000 rupees, but let them start and inculcate that habit. That is very important for our clients, because if one generation does it right, the rest of the lifeline can be sorted out. One generation has to get it right. Okay. Any questions so far?
I think the distinction is how you explain retirement. It's financial freedom.
Financial freedom at the end of it. It doesn't have to be an age. You can retire at 30, nothing wrong. And you can take up your hobbies, you can do something else, you can do something you're passionate about, you can do freelancing and things like that. We have people in HR, in marketing and things like that who at the age of 60 started doing freelancing. And we told them that the day your freelancing is not covering your expenses, we will start, putting in action your retirement plan, and the corpus will start giving you the amount. Today they are 67, 68, until now their freelancing is going great. They have not taken a rupee out of their corpus. Okay, so retirement doesn't have to be a stringent phase. Okay, today my dad is 64 and he's not retired. He comes to office every day. The only reason is because if he is at home, he doesn't know what to do. Okay? So he is semi-retired. He's no more working for money as such, but he's doing it as a passion. He's doing it because that's something he's been doing for the last 30 years. So it's just in his blood. Okay, he cannot sit idle. He has to trade, he has to buy, he has to sell. Something's going to profit, something's going to loss, but that's okay. So now we'll get into a little more technicalities. There are, in the screen, if you see, there are 4 images. The 4 images are ideally the 4 asset classes that you can invest in across the globe. Okay, on the left side, you see something called a bank. These are called fixed instruments. Fixed instruments are something like your FD, your RD, bonds, debentures, anything where you know the percentage of return you're going to get when you enter into the product. Today, if you're entering in an FD, you know how much return you're getting. So those are fixed instruments. The reason they're fixed instruments and they're guaranteeing a return is because they're not putting the risk on you, they are taking the risk. How does a bank give you money? When you deposit an FD in a bank, they take the FD, give it out for a loan at 12%, or they give it out a bond at 8%. Okay, they give you a guaranteed return of 6.5%. The remaining is their profit. That's pretty much what a bank is doing. They're accessing their risk. They're taking your money and lending it to someone else, and they're making the differential. So because the risk is not on you, you're getting a guaranteed return. The other 3 on the right side are real estate, commodities like gold and silver, and equity. Across the globe, there are other assets. Like 50 years ago, people used to invest in art. Today, people are doing cryptocurrency. Any of you doing cryptocurrency here? No? Okay. Okay. So today, there are these asset classes, but the challenge in these asset classes is they're not backed by anything. Okay, there is no physical thing that is backed. Yes, there is a blockchain technology and everything. But the point is, unless and until every government legalizes it, it is very difficult to put a real valuation. Today, a McDonald's in India might say that we accept Bitcoin, but are you willing to pay 1 Bitcoin for a burger? No. So they will start doing fractional, something like that. But unless and until every government puts a real value to it, it is not an actual asset. Okay, it only goes by demand and supply. But these 4 assets have either a physical property behind it or something linked to it. For example, real estate, you have land, you have apartment, you have properties. Gold and silver, you have the metal that, technically today is limited in the world. You can mine only that much. Okay, even Bitcoin is also limited to 21 million. You can mine only that much. And equity is backed by company stocks, company ownership. Okay. Today, for example, if you have, let's say that he owns 100% of the company or 80% of the company, if he sells 5-10%, that is equity ownership. You have a stake in the company. That's it. So today, if you're in the equity markets, you can buy companies like Infosys, Wipro, TCS, all of these. That's basic. So these are the 4 asset classes across the globe. The difference is in the bank or in the fixed instrument, it does not beat inflation. The other three beat inflation. How much do they beat inflation? Commodities are the cause for inflation. In India, it's restricted to gold and silver, but across the globe, you can invest into oil, you can invest into cotton, wheat, copper, steel, all of these things. Okay, so when these prices go up, inflation also goes up. So they are linked to inflation. If the inflation of the country is 6%, they'll give you 6% return. Real estate historically has been giving 2% more than inflation. When the country is developing or when the city is developing, like tier 2, tier 3 cities, you can see very good growth in real estate. But once it stagnates, it either becomes unaffordable. Today, if you want to buy a property in this area, you will have to spend at least 30 to 40,000 per square feet. Okay, so 1,000 square feet area will cost you 4 crores. Not feasible. What is the rent? Realistically, if any of your families own real estate, especially an apartment or a house where you're given out for rent, you divide it and see what is the percentage of return that you are getting. Okay. Today, if you have an apartment that costs 1 crore, the maximum rent that comes is roughly around 25,000 to 30,000 a month. So in a year, if it's roughly 3 lakhs or 3.5 lakhs, divided by 1 crore, you're getting 3% return on rent. So if your property is not appreciating by 5% every year, your real estate is not beating inflation. Do this calculation at your house, and then you can decide whether it is worth to invest into real estate or not. Okay? The final thing is equities. Equities historically in India has always beaten inflation by 4% on an average. But the biggest benchmark for equity is country's GDP plus country's inflation. If the country this year, in the last quarter, they came out with a result of 7.8%. Inflation is roughly around 4%. So you can expect equity returns on an average basis, roughly around 11 to 12%. Okay. When a country develops, the interest rates keeps falling down. If we want to become a $5 trillion economy, and if we want to beat Germany, we've already beaten Japan, as they say. But if we want to keep increasing, not GDP per capita, just GDP. If we want to keep going up in our GDP, interest rates has to keep falling down. Because if, today Adani can get a loan in Japan for 0% or 1%, and in India he has to pay 4%, why will he come here and take a loan? Right? So it has to keep falling. So when it falls, eventually your GDP slows down, your interest rates go down, inflation goes down, equity market returns also will go down. Okay. In the last 5 years, on an average, because of COVID, there's a lot of liquidity. People have got on an average roughly 30% per year kind of a return. But realistically, over the last 5-7 years, if you see an average, people have got roughly around 12% kind of an annual return. It does not mean every year you get 12%. 1 year will be 10%, 1 year will be 0%, 1 year will be 4%, 1 year will be 14%, 1 year will be negative 4%. On an average, it subsets. So anytime you're investing into equity, if it is an actively managed thing, you will have to keep it for 5 to 7 years minimum. If you don't have the clarity that you might want to withdraw it within a year or 6 months, don't enter into equity markets. Okay, that is why we say that when you are young, you go into equity because you have the duration, you have the time period, and I'll tell you how time period also is very helpful. So this is the most important slide of the presentation. It's called the financial pyramid. In personal finance, this has to be the backbone of how you're going to plan yourself. Okay, the basic of the financial pyramid is liquidity. Liquidity is simply to tell, am I earning enough money to take care of my loans, to take care of my expenses? If you're not earning enough to take care of your own expenses, then you have to increase your income. Unless and until you increase your income, there is no way that you can be, financially secure. Okay, but if you are earning a good amount, if you're earning a decent amount where your expenses and your loans, you don't have loans today, but in case your expenses and everything are lesser than your income, then your base of the pyramid has been set. Okay, the second one is protection. Any of you here have life insurance, health insurance, personal insurance, anything? You have? Which one? Life, health? Health insurance. Anybody else?
Health?
Yeah.
From parent scheme.
From parent scheme. Okay.
Health from savings account.
Savings account scheme, okay. Okay. So insurance is the second backbone of the pyramid. Because now today, most of us have grown in a traditional family where mom was a housewife, dad was the sole earner of the family. But God forbid, in a family where there's 4 people and something happens to the dad, then what will happen to the family? They're devastated. There's no income. There is, the commitments or liabilities is there. Children's expenses, children's tuition fee, college fee, marriage, all of those things are still due. So what happens? The most important thing that anybody should have is life insurance. It is to secure your life. Don't go for LIC plans. Don't go for saving schemes. Don't go for ULIPs. A simple term insurance for 50 lakhs or 1 crore or 2 crore, they give you 25x of your income today. It's a simple expense if you're all very young. The amount that you enter with. So today, if you go for a 1 crore policy, the premium might be roughly 10,000 rupees a year. Okay. But for the rest of your life, the premium will not go up in life insurance. It is at the day of your entry, you are sticking into the premium. So then, let's say 20 years down the lane where you're earning 1 crore a year, 10,000 rupees is nothing. But you'll still have 1 crore cover because of it. So it's very important to ensure that the day you start working, you take one simple term policy, only term policy, which will cover maybe 1 crore or 2 crores or how much ever 25x your salary gives. Take it. You will thank me later that, good I took it at that time, because the challenge in life insurance is how life insurance works is there is a basket. Okay. There's a basket of 100 people and they say that 3 people in every 100 people die. For these 3 people, they will have to give, let's say 10 lakhs each. So they take the 30 lakhs, divide it by the 100 people, and then let's say that each of your premiums is so much. But imagine a basket where instead of all healthy people, there are few people who have diabetes, few people who have blood pressure. There instead of 3 people dying, 6 people die. So then automatically your premium becomes double. So when you're healthy, you get into a life insurance commitment, take it for 30, 40 years, where it's going to be only 8-10,000 rupees per year. In fact, now with the new GST law day for yesterday, there's no more tax on insurance as well. So you will save another 18% there. So it might cost you only 6-7,000 rupees a year. So once you take that, you keep it for the rest of your life. You can always surrender it by just stopping to pay the premium. If you feel like you don't need that cover anymore and you have enough financial assets to take care of the rest of your life, you don't need to continue that insurance. But take a proper, simple term plan. That is life insurance. Second is health insurance. Any kind of, all of us will have medical issues because today we are eating processed food. We have a lot of stress. We are sitting in one chair. At least your company is very good that you are having football games and everything. But majority of the other companies don't have this kind of activities. They sit, they come in the morning, work 12 hours, and then they go back home, sit in traffic for 4 hours. And that's pretty much their entire daily activity or physical activity they're getting. So they will end up with health issues. So when that happens, when you go to any kind of an hospital, the bill comes up 3 lakhs, 4 lakhs, 5 lakhs. You'll end up spending 6 months of your income for that. Does not make sense. So rather take one good personal health insurance. 5 lakh cover, 10 lakh cover is more than enough. Might cost you 10-11,000 rupees again a year. Okay. So your total expense for risk you're looking at is maybe 20,000 a year, which is reasonable to cover any kind of life risk, any kind of health risk. Okay. So these two things you should definitely look at. The third aspect under protection is emergency funds. Most of us are living with our parents, so today we don't need that big of an emergency fund because if something happens, we always have them to rely on. But tomorrow, if you're going to stay by yourself, you have your own family. A couple of our clients during COVID period, they lost their job or they had to take a salary cut. Everybody in the family got COVID. So expenses shot up. So then obviously there'll be a panic that how am I going to spend so much and I have no income for hospital. Markets fell by 40%. So all of their investments also got wiped out for that 6-month period. So rather than living on the edge, you build up an emergency fund that takes care of at least 1 year of your expenses. So even if there is any kind of a risk that affects you, you know that for the next 1 year you are financially secure. You have enough money set aside in an FD or in a debt instrument which is not related to the market to take care of all of your expenses. Okay, so these 3 things are very important protection. Only once this has been set, do you actually get into basic requirements. Basic requirements are your savings and investments, what we spoke about since beginning. Then comes goal planning. Some of you might be young today for a goal planning, but the moment you decide 5 years down the lane, I want to buy a house. 5 years down the lane, I want to buy a car. 10 years down the lane, I'm going to have a child. 8 years down the lane, I'm going to get married. Things like this. Or the biggest thing, for most of you might be education. 5 years down the lane, I want to go do an MBA or a master's in computers, things like this as well. So if your parents are taking care of it, well and good. If not, if you want to build your own corpus, you need to start doing that from today. Okay, because especially if you're planning to go to a very good institute like IIM, ISB and all, they charge you no less than 30-35 lakhs for the full course. Okay, if you're going to US and all, it's going to be at least 60-70 lakhs or even 1 crore depending on your living expenses and all. So if you have that aspiration that you want to study further, 5 years down the line, you want to study and do an MBA or MSc or something like that, then that is where your goal planning comes in, that you need to start saving for it. Okay. And the next part of goal planning is retirement purpose, which is a huge calculation, goes in tens of crores. But that's something you can always start small, start putting whatever chunk you can towards the retirement. It will come in use in a rainy day as well. Okay. The final aspect of the financial pyramid is growth. In growth, there is two things. One is higher risk assets. I want to invest in a startup. There are startup funds today that we are also doing. But is it for me or not? I need to know only if everything else, my insurance, if my savings, if my goals are set, only then I can put some money into those products. Otherwise, because in a startup, it can give you tenfold return, it can become zero as well. Are you willing to take that risk? If that becomes zero, your rest of your life goals should not go for a toss. So those are the growth aspect. The other thing is estate and legacy planning. This is the most important thing that we tell our clients, especially once they cross 30, 35, or if they have any real estate under their name, that you need to either have a trust, a registered trust, or a registered will. It's a very sensitive topic to talk at home today because our parents or grandparents think if we talk about will, that means you're going to die. Okay. That's the biggest challenge that we see. But then if you don't have a registered will, to get access to your own family money, whether it's a bank account, whether it's insurance money, whether it is, real estate, and get it transferred to your name, at every stage of every government office, you have to pay them 1 to 2% of whatever is the amount. Can you imagine? For if you have a real estate or a house worth 10 crores, for you to get access and transfer that name, a lawyer will ask you for a probate, BBMP will ask you for any kind of documentation, both of them will ask you for 2%, which means 40 lakhs goes away only to get your own house transferred to your name. So therefore, we tell all of our clients have a registered will. The will is a government document which is registered with BBMP. They will have a copy of it which says that the entire property or the entire asset goes to the rightful heirs. That is whoever has been given in the will. Okay. Nomination is different. Nomination does not have access. Nomination has only access to the funds, but is not the rightful heir. Okay. Today, if one person has put their wife as a nominee, okay, then that means the wife has access to the bank account through the nomination. But the money should not be spent by the wife. The Hindu succession law says whatever assets are there in the father's name gets divided equally towards the mother, the spouse, and the children. So if there is 1 crore sitting in your bank account, 25 lakhs belongs to the grandmother, 25 lakhs to the spouse, 25 lakhs each to the children, if there's 2 children. So the wife cannot entirely spend the 1 crore. If she does, it is legally wrong, and even the children or the mother can file a case. Okay. So make sure that you have a registered will. We have seen cases, thankfully not to us because we have partnered with an estate firm, but they keep telling us stories where, there is a family of 4 people, the father, the mother, the wife, and the child staying in a house. Father, mother, grandfather, and child. Okay. Father passes away in an accident. So technically, the father does not have any say in the house as per Hindu succession law. The very next day after all the rites, the wife kicked the father out. So we have seen such cases happen where it is, very sad that because our legal processes are also slow and people are not aware of the estate planning or the succession planning, 63% of all real estate in India is under any kind of a legal issue, majority because of succession. Okay, so these are something that is a sensitive topic. You should talk about it at home, or we have professionals who will help you and talk to them as well and explain what is the impact. To get a registered will, it does not cost more than 10-20,000, but it will save you at least 20-30 lakhs. Okay, so this is the most important aspect of growth. And if you look at the triangle, even if the growth portion becomes zero, you don't have to worry because everything else has been taken care of. Any questions on this? All right. So we'll get into some numbers. The power of compound interest. There is a rule called rule of 72. Any of you know about this rule? You know. So there's a rule called rule of 72, which says that if you divide the interest or the return that you're getting on a product by 72, it will tell you in how many years will the money double. So roughly, if I'm saying if I'm getting a 12% return on a product, 12 by 72, 6. So that means every 6 years your money will double. So today, if I have 1 crore, if I'm getting a 12% return, in 6 years it becomes 2 crores. In 12 years it becomes 4 crores. In 18 years, how much does it become? 8 crores. Okay. So today, if you start and if you give it the time, compounding works beautifully. So we'll take a example of two sisters, Ananya and Mallika. Ananya starts in, so she is the blue line. She starts investing at the age of 25. Okay, she puts aside 50,000 rupees a year for 10 years, and then she stops investing at 34. That's all she has done. She gets married, she gets a lot of commitments and things, so she stops investing. And her corpus of 50,000 for 10 years, which is 5 lakhs, grows to an X amount. Her sister sees this kind of a return and she's like, wow, that's great. Even I will also start investing. So she starts investing at the age of 35 when Ananya stops. Mallika is a sister, she starts investing at 35. She puts 50,000 a year for the next 30 years, till retirement, till 65. Okay, but if you look at the blue line, because the time duration was great and the compounding keeps doubling her, this is taking 9% kind of a return. Okay, at the age of 65, Ananya's corpus is 1.09 crores, whereas Mallika's is only 74 lakhs. So that is the difference of 10 years gap. Even though Mallika has invested for 30 years and Ananya has invested only for 10 years, this much difference, almost 30% difference you can see in the corpus. Okay, so it's very important to start early, start small. So simple, let's assume there's a 32-year-old parent who just had a child is 1 year old. This year is 2025, and let's say that the client wants to save for the children's graduation. Okay, today maybe they want to send them abroad or some specialized course. It might cost 75 lakhs for the entire 4-year course. Education and healthcare inflation in India is anywhere from 12 to 14%. This is the largest inflation. But let's take an average inflation of 10%. 18 years down the line, if something is costing you 75 lakhs today with a 10% inflation, how much do you think it will cost in the year 2043? Any rough guesses? Yeah, from now.
How much?
75 lakhs is the cost, 10% inflation, 18-year duration. What do you think will be the number?
72 by 10. In 7 years it will double.
So give me a number.
So around 2 CR.
Okay. Anybody else? Any rough numbers? No? 3.5 crore, getting closer. So the cost is going to be 4.17 crore. Looks very unrealistic, right? Looks very unrealistic, correct? But ask your parents how much did they spend on education? In their college, 200 rupees to my dad for his masters in commerce, he spent 2,000 rupees. Whole course 2 years. 2,000 rupees. Today, what is the value of 2,000 rupees? So it seems very unrealistic today. But going forward, you know, slowly when numbers keep adding up, you will see these numbers and you will realize you're not prepared for it. Okay. So the final aspect I'm going to talk about is insurance. Insurance is basically the risk of a few shared by many. As I told you, in a basket of 100, if 3 people or 6 people are due for any kind of a medical thing or a life risk, then that cost will get split amongst all the 100 people. That is the premium that you pay. The earlier you get into insurance, the cheaper it is. And especially life insurance, you should look at getting at least a proper term insurance when you are young. Health insurance, you can always take it because today your parents you will be part of their plan, but insurers will keep it only till the age of 25. Post 25, you will have to get an independent policy, or if you are part of that policy, they'll give you a split policy. Okay. So just a little bit about us. Started operations in 1994. This October will finish 31 years. We are into personalized planning. We are not, we don't just tell you that put into HDFC, put into ICICI. We look at what your requirements is. We look at where your goals are, what your savings potential is, and we will create a personalized plan for you, telling you this is what you should start off with. This is what you should look at. This is what you should increase on a year-on-year basis. Like most of us get 8%, 10% increments every year, maybe 5%, 6% in a bigger company. If you're working in TCS and all, maybe 2%, 3% increments. But then in that also, you will have to be disciplined enough that saying 50% of my increment will go towards my long-term savings. The remaining 50% is for me to enjoy. Okay, so these are all things that we look at. We also look at tax harvesting, wherein on long-term basis, every year, every PAN, you get 1.25 lakhs, tax exemption in equity. So we will make sure you book profits and reinvest the same amount. So when you are finally withdrawing your corpus, that much amount is tax-free for you. Okay, so there's a lot of things that we do. We can help you with PMS, we can help you with AIF, we can help you with estate planning, will writing, all of these things. If it's not directly through us, we have a network available. Okay, so if it's a challenging health insurance case or something, we have somebody available in our network to help you with insurance. If it's writing a will or something, we don't do it in-house. We have a sister concern who will help you with, forming a trust, forming a will, and things like this as well. So yeah, that's pretty much it from my side. Thank you so much. Any questions? I'm leaving the floor open. If anything you have, any questions regarding your financial things.
Can you tell the difference between NPS and 401?
Yeah. So NPS here in India is National Pension Scheme that the government runs, wherein 60% of the committed amount at the age of 60, there's a lock-in till 60. Only post 60 you can take out from your NPS. At the age of 60, you can take out only 60% tax-free as a lump sum. The remaining 40% has to be annuitized. Annuitized means you go into, and you get a monthly pension kind of a thing. The challenge there is the government is forcing you to take NPS or you're putting money through government. But when you have to annuitize it, the government does not give you the payout. You have to go to an insurer like SBI or HDFC or ICICI and buy an annuity product from them. And based on the interest rates at that time, 2%, 3%, 4%, they will give you that return on the 40%. So therefore, the government is telling you save for your retirement, but at the time of retirement, they are not taking responsibility for the money. In a 401k, the government is giving you from their sovereign banks, okay, plus it is inflation linked. So if the country's inflation goes up by 4% or 6% in a 401k, they will give you that return. But in India, they don't give you inflation rates. If they are giving you inflation linked, it is a great product. But they are going to fix your return on the day of retirement and you're stuck for it for the next 30, 40 years.
So interest rate is fixed?
Interest rate is fixed as per Indian rates.
For today.
Yeah. So today, if you take an NPS, okay, FD rates are 6.5% minus 1% for all of their expenses, you will get 5 or 5.5% on the 40% of your NPS corpus. In US, it's not like they're inflation linked. In the last 3 years, their inflation went up from 2% to 6%. 401k also gave them 6% return.
Can you explain a bit more about AIF?
Yeah. So alternative investment funds is a SEBI regulated category where there are 3 categories: Cat 1, Cat 2, Cat 3. Okay. Cat 1 and Cat 3 are highly regulated, wherein Cat 1 is basically long only funds that invest into mutual funds and things like this. Cat 3 is where they have long short funds. Long short funds. So today, if you are investing into the market, you let's say buy Infosys share at 2,000 rupees or something. Okay. Tomorrow, if Infosys becomes 2,500, then you get 25% return. If it falls to 1,500, you lose 25% of the money. On the short aspect, today mutual funds are not allowed to do shorts. There's a new category coming called SIF, Specialized Investment Funds, that has a minimum requirement of 10 lakhs. But that category, along with AIF category 3, has a short, which is basically like a hedge. So today, let's say they have 10 lakh shares of Infosys. Okay, they suspect that tomorrow Infosys will fall. Okay, so on the short side, for today's rate, they will commit a sale. Saying 3 months, the maximum turnaround is for 3 months. So let's say 3 months down the line, they will say, I'm going to sell you Infosys share for 2,500 rupees. These guys are bearish, saying that it will fall down to 2,000. The opposite side is bullish, saying it will go up to 3,000. Okay, so they will commit at 2,500 rupees and say 3 months down the line, I'm going to sell you my 10 lakh shares for 2,500. Now 3 months time has passed. Let's say the stock falls to 1,500 or something, 1,500 or 2,000, whatever. These guys will buy it from the market and sell it for 2,500 and fulfill their commitment. They make a difference of 500. Okay? If the price goes up to 3,000, okay, they have a kitty of 10 lakh shares. They will take out the share from that and fulfill their commitment. So that is the short hedge of it. Okay, so when they do long and short, they're covering the hedge position. The only challenge is if the market goes up by, let's say, 10%. Here, because the long only side is 60%, they will get only 6-7% kind of a return. The remaining 3-4% is hedged against it. So it is usually, we use it as a downside protection. If somebody has 5 crores and 5 crores is fully in the long only market, I don't want to take a risk. Tomorrow, if something like COVID happens, market falls by 40%, that 5 crores overnight will become 2.5 crores. I don't want that risk. So therefore, I will take 1 crore out of it and hedge it in the long short category. So if the market falls by, let's say, 10% or something, the portfolio will fall by 6%. But in this, the hedge will give you an additional alpha of 1-2%. So your fall will only be 8%. So you're still better than the market. In category 2 in AIF, it is everything that is not listed in category 1 and category 3. That is the SEBI definition. Basically, VCs, startup funds, leverage funds, anybody, any bank or any company raising loans, debentures, all of these things fall under category 2. Category 2 is, unlimited kind of opportunity space. Today, there's one company that we work with called Finwall, which does only startup funding. Okay, so they fall under category 2, wherein they pool the money from all investors, create a fund, and any startup that is coming through their partner company called Accelerator India. So, they work with them and give them funding. Whatever returns they get, they will again divide it among all the investors. So that is Cat 2. Any questions?
How to figure out what money to put where? Like, how do I know how much money to put in real estate and equity or debt or equity?
Okay. Good question. So there is no standard structure or a model portfolio that will work for everybody. Okay. It depends on person to person, goal to goal. If some of you want to live independently, then you might require real estate. If you want to continue living with your parents, then you don't require real estate. And today it might be your decision, but when you get married, it's a joint decision as well. Okay. So things like this is where we'll have to understand your profile better, your risk better. But if you are earning a limited amount and, let's say today an apartment in Bangalore costs 1 crore and we have a savings potential of 30,000 or 40,000, obviously it will take a long time to invest into real estate unless and until you go through the EMI route. Okay? EMI does not make sense because it's a huge commitment for the rest of your life. Okay? So therefore, if you have small corpuses, get into equity, get into commodities. Once you build the corpus, you can always shift it to real estate. That opportunity is there. A lot of our clients will, build the corpus for 10 years. And then once they have a child or something, that time they will redeem some of this money, buy a house, and then move into it. Until then, they live on rent. So all those opportunities are there. It depends on your personal timelines. Okay, personal preferences, personal timelines, things like that. My number is here. My email is here. I'll leave some cards here as well if you want to. And you can feel free to call me anytime. So we tell all of our clients that, it doesn't necessarily have to be that you buy any products from us, but you can always use us as a sounding board. Any decision regarding financial aspects that you take, whether it's taking a loan, not just your personal, even if it's your family's aspect as well, we don't charge anything for advice as such. So we can guide you and we can tell you what is the best aspect of it, what is the advantages, what is the disadvantages. In our experience, what we have come across, we can share that with you. At the end of the day, you guys are responsible for your own decisions. You are the decision maker. We will enlighten you, we will give you the knowledge about it, but whatever you decide, if you want our assistance, we can do it. Or if you are going ahead with it on your own as well, you can.
I still think some people have questions.
Please go for it.
Should I get my mutual funds from an advisor or like broker?
Yes.
Or should I do like direct plans?
So there is okay. The difference between a direct plan and a regular plan is something called a TER, total expense ratio. Okay. So these are all SEBI guidelines. It will be anywhere from 1% to 2.5% is the total expense ratio, out of which distributors get anywhere from 0.3% to 1% as a fee. Okay. Now, if you are going through a distributor or if you're going through a regular plan, you are paying them commissions, you're paying them on a regular basis, but they are managing your funds. So if they're adding a value, then you should go through them. Okay. If you are 100% capable of managing your own funds, if you are sure that today the corpus is 5 lakhs, I can manage it in an index fund and everything, great. Tomorrow, when it touches 50 lakhs, are you able to manage it on your own? Tomorrow, if it touches 1 crore, are you able to confidently say you're doing the right thing? Then go through direct plan. If you have any doubts whether you're doing it right or wrong, and if your time is very valuable, if your time is very limited where you're not able to manage your own funds, then go through a regular or a distributor or an advisor who will take a fee out of it. But then at the end of the day, see, you have options today to compare. You can invest 1 lakh through Zerodha, and you can invest 1 lakh through a distributor. Give both of them maybe 3 years or 5 years time, and after 5 years you see who has given the better return. Run this exercise once. If the distributor or the advisor is giving you some value and beaten your Zerodha account, then post expenses, it always makes sense to go through them because they're giving you better returns. But if your Zerodha account has given you more kind of a return, then you are free to manage it on your own as
So
well.
the mutual fund plan is same. Only the distribution is direct.
So that is the thing. So there are fee-only advisors who give you the plan as well. But the challenge is, how much to the plan are you able to stick to it? Are you able to do your own quarterly reviews? Even if you go to a mutual fund plan, they will charge you a percentage of the AUM. Or if it's a fixed fee, they will charge you 10,000, 15,000, 20,000 as a one-time thing. Every time you go to them, they'll charge you 10, 15,000 roughly. But they will give you maybe a 5-page plan or 10-page plan saying that this is what you should do. If you have the capacity to do it by yourself and manage it, and keep going to them every quarter or every year or something to make sure your plan is correct, then it is good to follow that. The challenge, what happens in our field is, today there's more than 7,000 schemes, mutual fund schemes. Okay, more than 5,000 listed stocks in India. At any given point of a time, anything can change. So if you're not actively monitoring, only when you go to the advisor, they'll tell you, oh, this fund has completely gone down, you should actually get out of it. By then, the rest of the country would have actually gone out of it. You are investing today? Yeah. You have quant funds? No? Why?
And they were like the time.
Okay. Then what funds do you hold?
PPFs.
PPF, Parak Parik. Anything else? No, that's it. Only one fund. Okay. So when it's only 1-2 funds and it's a limited corpus of 3 lakhs, 5 lakhs, it's a good opportunity. Okay. But as and when it goes into tens of lakhs, as and when you're looking into PMS, AIF, different strategies and things like that, it becomes very difficult for your own self to manage it. Okay. 5 years ago, quant funds were a roar in the market where everybody were like, computers are able to pick better stocks than people. Everybody got into it. The biggest challenge what happened in quant funds is, especially I thought, a company of AI people might have invested in quant funds, but surprised they have not. So the biggest challenge what happened in quant funds is, they always go on historical data. They have quantitative data. They are not able to analyze qualitative data. When that happens, they have all the IT companies, because they have huge reserves, huge balances. Historically, they have been in the top 10 in Nifty. Today, TCS, Wipro, HCL, all of these guys are in the top 50. So they have invested into IT companies. But active fund managers like Parag Parikh as well have identified that there's a huge shift in the IT industry, and Indian IT is not a product-oriented, service-oriented. So their profits and margins will cut down. And today, even if you look at PPFS, they have Alphabet, they have Google, they have Microsoft. They don't have any Indian IT companies. They exited every active fund today has exited IT companies in India, because they feel in the future there is no kind of a growth. A mid-cap IT might do better because they are, in today's innovation stage, they have implemented AI and things like this. Large companies like Infosys, Wipro have not been able to change direction that fast. So these are things that you should know when you're entering into the fund. Today, Parag Parikh has been an exceptional fund in the last 3-5 years. Any idea how you chose that fund?
I follow Raj Thakur.
Okay.
So I visit his webinars.
So, if it's a good influencer, if it's somebody good who's not working for money, then you can always follow them. If not, if somebody is giving you something free, then you have to realize you are the product. Okay. So there's nothing free in this world. So if you're getting something free, then that means the cost is somewhere hidden. So everybody today will have some kind of cost. Otherwise, even today, if you are doing some kind of a service, would you want to do it for free? No. Correct?
How do we invest in stocks that are not on the Indian stock market?
So you have a couple of options like IND money. You have interactive brokers, and the challenge there is the fee. Okay. So today, if you look at interactive brokers, they have partnered with a couple of banks like ICICI and all. And if you are investing, so you basically have to transfer your lump sum into the demat account and then buy the foreign stocks. But when you do that, for each transfer, they will charge you 1,000, 1,500, 2,000 rupees as their fee. Apart from that, you have an exchange rate fee as an exchange fee. Now, if you're doing 10,000 rupees, and if you're paying 2,000 rupees for each transaction, 20% of your cost is gone only for that. And if the return is even going to be 10%, then that means you are still negative 10% kind of a return. Only if you are moving chunks of money like 2 lakhs, 3 lakhs, 5 lakhs, it makes sense to go through these brokers. RBI has put a ceiling of $7 billion. So today, most of the mutual funds are not investing internationally. Okay, they have some restrictions because of that ceiling. The second best option is through Gift City. So Gift City is a wonderful option, but the minimum requirement there is $10,000. Okay, so that is the second option. So technically, when we are building a client's portfolio, we look at diversification through milestones. So the first 50 lakhs will be only into pure equity. When the client's money crosses 50 lakhs, it's going to have some gold, silver, commodities to hedge the portfolio. When it crosses 1 crore, it might have an SIF product. When it crosses 1.5 crores, we will give them any of these international funds where the minimum requirement is 10 lakhs. So that has some, 8%, 10% or 5% of the portfolio weightage. When it crosses 3 crores, we'll introduce an AIF, things like this. But for a retail investor, IND money, vested, IBKR, that is interactive brokers. These are the only 3 options that are available. And India VIX. Now, these are the only 4 options that is available where you can go directly through them, but you will have to pick and choose your stocks.
You want to make money with NVIDIA.
But the cost is high. The cost is going to be high. So, see, you have to look at the differential. Okay. If Indian markets are roughly giving you 10% return on an average, and if your cost is going to be an additional 10%, then the alpha that you generate from the US market has to be more than 20%. Only then it makes sense for you to invest in US. Companies are great, the Max 7 is great, beautiful opportunities, all of that is there. But in terms of percentage and expense, if it is not making sense, there's no point of entering into that market. Yes. Answer?
Not educated.
Not educated. Rahul is asking. Yeah, Rahul.
No, I just wanted to could you drop your contact in the chat, please?
It's on the screen, but my number and the email ID is on the screen.
I'll share.
I will leave some cards, and Pradeep also share my contact as well.
Okay, cool.
Okay.
What are some absolute red flags on things that just 3-4 things you just should not do?
Absolute red flags which you should not do in terms of, especially when you're starting young. Don't buy anything where a person that you know has a vested interest in. Okay, such as ULIPs, insurance plans. If your uncle or someone comes and says, I'm an LIC agent, you buy this product, don't. Okay, it is for their own personal benefit. All right, that is one thing. Second thing, don't invest into the hype. Investing is going to be a boring, long story. Okay, but that is what makes money. The rich are loud, but wealth whispers. So remember that. Somebody walking on the road, you will not see wearing a small shorts or shirt or this thing. They could be worth 3-4 crores. You will never know. Okay? So wealth whispers. So don't go into the hype. Trust your instincts. Anybody that says that I'm going to give you a fixed rate of return, I'm going to give you 10% return every year, 15% return every year, run away from them. CFP and RBI has spent lakhs of rupees on investor awareness programs to tell them that if anybody is saying that we're going to double your money in the next amount of time, that means by the time the doubling time comes, they will run away with your money. Okay? Don't get into it. There is nothing in this world that is free. There's nothing in this world that is guaranteed. Everything comes with a risk. So especially things like cooperative banks, small banks, things that they will tell you, we'll give you 10%, 11%, 12% return on an FD. But how is that possible? Think about it yourself. If they're giving a loan at 18-20%, okay, they can give you a 12% kind of a return on FD. If they are giving out loans at 12%, 15% today, credit and all of these NBFCs are giving you online loans at 12%, 15%. Okay, so how is a cooperative bank giving you 12%, 15%? The kind of people that take loans who at 12%, 15% are the people who have been rejected by nationalized banks. So these are people that will default in their loans. So that means there's a higher risk in their money. Okay. In terms of mutual funds and everything, mutual funds today, on an average, are very safe, 100% regulated through SEBI, Securities Exchange Board of India. If you look at mutual funds, their structure itself, it's not a company. Today, if you look at HDFC AMC or ICICI AMC, they're backed by a sponsor like a bank, but they have a board of independent trustees that regulate the company. But even in between, they have NSDL and 3DSL as custodians, and they have KFinTech and CAMPS as RTA agents, register and transfer agents. They are the ones who are owning up to every investment that you have, and these four bodies are regulated through SEBI. Okay, so tomorrow, this might not happen, but tomorrow, even if a big company like HDFC AMC gets bankrupt, you don't have to worry about it. Your money is safe with a custodian. Okay, under SEBI. So mutual funds is the best product that you can enter into. Don't go too aggressive. Don't go into thematic funds today. The things about thematic funds today is, it is, have you seen like the giant wheel or the Big Ben in London? Okay, so imagine thematic funds like that. You enter when it's at the bottom, but when it's at the top, you will be so mesmerized by the returns that there is no way out. And by the time you want to get out, the cycle would have completed. You will have to again exit at the bottom.
More context. Thematic funds. Everybody know what this is.
Okay, so thematic funds in India, they are like, okay, so out of these 7,000 schemes that are listed in India, there's specific themes that a fund manager will come across and say, like for the next 5 years, defense will do very well in India. Manufacturing will do very well in India. And they will launch a specific scheme, Motilal Defense Fund, HDFC Manufacturing Fund, that invests into companies only that are related to that sector. Okay? But the challenge with that is the giant wheel thing. That when the sector is doing well, everybody will see a 30%, 40% return. So it'll be like, this is doing great, I will not exit now. By the time they exit, it will come back to 10% and 7% return. Every theme has its time. For this year, people are saying FMCG, which is fast moving consumer goods. Like companies like ITC, HUL, all of these guys will do very well because two things. One, GST is now either 0% or 5% of products. Second, most of us have got an exemption limit up to 12 lakhs in income tax. So obviously, majority of the crowd will move into FMCG goods. So that will do very well. So a lot of people have put money into FMCG sector now. How long will it go? How well will it run? We don't know. If it does very well in the next 1 year, you can get exceptional returns. But then when it's giving you exceptional returns, psychologically, you should be ready to exit. You should not hold it. So today, 60% of mutual funds are all thematic funds. Parak Parik is a beautiful fund. It's a general diversified fund, which invests into all sectors. Okay, they're sitting on 21% cash. They're sitting on 11% foreign exposure, 24% banking, and 5-10% to cement, pharma, and things like that. That is a general fund. So if you're starting to invest, you start investing into general diversified funds. Don't look at past performance, because all your thematic funds will be trending in the past performance, but that means the trend is dying. So when you are getting into it, then somebody smarter is getting out of it.
Okay, my takeaway from this is, hey, investing is too complex. Let me not invest at all. And I just figure out how to manage my expenses better. And suppose I earn 50,000 rupees a month. What should I do? How do I split and say, okay, this much I spend on food, this much on fuel, this much on city? What are some high-level things that I should do to manage my expenses?
Yeah. So the best thing is budget it yourself. You have average of 50,000 rupees as an income. You look at it for 3 months. Okay. Look at it for 3 months, seeing how much you can maintain an Excel, or you guys are great at AI and stuff. You can track all of these things. Use some app like expense tracker and stuff like that. And it will start reading your SMSs and things like this, and it will tell you how much is your expense of 50,000 rupees going for Swiggy, Zomato, fuel, stuff like that. Okay. Then come to a figure where you're comfortable saying, okay, by default, I'm spending 20, 30,000 rupees. In your age or profile, you should not be spending more than 30, 40% of your income, because rent is taken care. Most of you, if you're going shopping with your parents, food and clothing is taken care. I was there 7 years back. I'm still living with my parents, thankfully, because I got married 2 years back. Wife is very comfortable with my parents, so we decided not to move out. Okay, so even for me, rent and everything is taken care of. So when you're able to budget that, put it down in an Excel or put it down in your app or something, and see how much you're spending. Try not to spend more than 40% of your monthly income. In that month, if you're crossing that, you see where exactly you can cut things. If you're ordering Swiggy twice a day or once a day, try to reduce it to maybe thrice a week, 4 times a week. Okay, so look at cutting things like that. If you are, maybe going shopping every week and spending 4,000-5,000 rupees on that, try to cut it down to once in 2 weeks. If you are spending a lot on Amazon, Flipkart, all of these things, look at the budget, look at how much you're spending and try to cut it down. Bring it to 40% of your monthly income. The remaining 60%, what you should do is left to you. Don't keep it in your bank account. Because the color of money is, if you see it, you will spend it. The moment you see I have 1 lakh in my account, you will go and buy something great. Like it might be a new phone, might be a new dress, something like that. So don't keep it in your bank account. Either put it in an FD or open a Zerodha account, open a Grow account or something. Put it into basic balanced advantage funds, which is a evergreen fund. Balanced advantage fund, what it is basically 50-50. 50% is into equity, 50% is into debt. However, that ratio can go into 40-60 as well based on market valuations. Okay, that's an evergreen fund. But then those returns will always be maybe 2-3% less than a pure equity fund, less than your parak fund as well. If you're getting into equity and if you ever invest into equity, make sure that you have a clarity that for the next 5 years at least you don't need that money. Have that simple clarity. Okay. So out of the 60,000, out of the 60% of your savings, if you're able to build a portfolio or diversify it yourself. Okay, what we do for our clients is, let's say that you come in saying 60% of your money, or let's say 30,000 rupees that you want to start investing. We say, first we'll build an emergency fund. We will buy some insurance out of it, and simple term plan and something like that might cost you 20,000 a year, not more than that, including health and life. And then the remaining amount, which might be 25,000 or something, we will put maybe 5-10,000 into large cap, 5-10,000 into mid cap, 3-4,000, 5,000 into small cap. We build that portfolio based on your requirement, your goals, and everything. If you're able to do that today, see, Zerodha Varsity is a beautiful page which teaches you ABC of investing. Okay, you go into Zerodha Varsity, they'll teach you everything available online, and they keep updating their pages as well on a weekly, monthly basis, so you can understand it yourself as well. For this generation, honestly, people like us are outdated, because anybody with 1-2 lakhs, 3 lakhs and all don't come to this, because they're able to manage this generation on their own. We get clients who have 50 lakhs, 60 lakhs, 70 lakhs, where they don't have the confidence whether they're doing something right or wrong. Okay? But start early, do something. We are always available to help. We don't have any threshold saying that if you come to us, you have to invest 10,000, you have to invest 1 lakh, you have to invest 2 lakhs. We start with even 500 rupees as well. Okay, like he was saying, he started with 5,000 4-5 years back. So we don't have any threshold as such. But if you're able to learn everything and give it that time, then you can do it yourself as well. The most important thing is you are spending roughly 40-50 hours a week earning this money. Spend at least 2 hours a month tracking it and monitoring it. Okay.
Surya, Jai Surya or Vidya, I want either of you to ask some question. What is your takeaway? Unmute here.
And he's there, unmuted here.
Okay.
Should be there.
Hey, Vidya.
Yeah, but I'm like we are thinking to ask a question. It's a totally new thing, right? So
It's a total
New thing.
new thing. Okay, okay.
Any question that comes to your mind? Vidya. Yeah, go ahead.
Okay, I want to ask one thing. Uh, what is SIP and mutual funds? Is both are same or different?
So mutual fund is very good question. We actually have a different product presentation when we talk about mutual funds. But mutual funds is ideally a vehicle. Now, if you look at these four asset classes, so these are the four asset classes. Mutual fund invests into all of these asset classes. You have something called a debt mutual fund that will invest similar to FDs. You have REITs, which is real estate investment trust, that invest into real estate through mutual funds. You have gold funds and silver funds that invest into commodities, and you have equity funds. So mutual funds is only a vehicle to invest into these asset classes. Now, how do you invest into the vehicle? That is through SIP. 95% of India's population in the working class are salaried. So when you're earning on a monthly basis, SIP is an automated structure, which is systematic investment plan, wherein it says that you should invest on a monthly basis. So let's say today, if somebody is earning 50,000, they say they want to do an SIP of 30,000. They do an SIP on a monthly basis of 30,000 into mutual funds. Okay, so SIP is the way to invest. Mutual fund is a pass-through entity or a vehicle to invest. These four asset classes are the products to invest. After SIP, you have something called STP as well, systematic transfer plan. That is when you have a lump sum amount sitting somewhere and you want to invest into the market. Today, for example, if I put in, let's say I'm sitting on 10 lakhs and I want to put it into the market. Yesterday, the US job data came out and the US markets were very negative because job creation was only around 74,000 or something. It wasn't as per their levels. So Monday morning when markets open in India, markets will fall. Okay. So when it falls, if I put 10 lakhs yesterday and tomorrow if market falls, let's say it won't fall so much, but if it falls, let's say 5% or something, then overnight 50,000 has been wiped out of my principal. So I don't want so much volatility when I'm putting lump sums. So what we do is one level above SIP is called STP. We put this 10 lakhs into a liquid fund, which will give you similar to FD returns. And on a weekly basis, we take out 20-30,000 completely automated and we put it into the equity market. So it's averaging your entry level. So over the next 6 months, you will get an average entry level. In case there is a huge correction in the market, then we take an additional lump sum of, let's say 50,000 or 1 lakh and we pump it into the market because you're getting it at a discount. So that is SIP and STP. There's something opposite to SIP called SWP, systematic withdrawal plan. So today in your life, you are all in the accumulation stage of life where you're earning a money and you're saving out of it. When you retire, you want these passive funds to take care of you. So that is where SWP comes. It is the exact opposite of SIP, wherein we give a standing instruction to the corpus saying that redeem 1 lakh every month and credit to your bank account, and that will replace your income. So that is SIP, STP, SWP. Hope I was able to answer your question.
my question is, which thing I should prefer, like short time long investment and small returns, or else long time short investment and long returns?
Consistency and discipline is the best. Okay, so if you have the time to stay in the market for a long time, putting small chunks of money every now and then, or in a systematic way through an SIP, saying that okay, 20%, 30%, 50% of my salary, let it go for long term. That is the best way to build wealth.
Okay.
Yeah.
Good question.
Okay. Okay. You're all set? Yeah.
One is opinion on read, another is
if you're investing in gold, what is the best one? Digital gold, ETFs, or
Exactly. So REIT is very nascent in India today. There's only 4 or 5
Explain
listed.
what REITs are.
Okay, yeah. So REIT is real estate investment trust. Okay, you have companies like Mindspace, you have companies like Embassy, Bangalore-based companies. So they have Embassy Golf Links, they have Manyata Tech Park, they have so many, office spaces, and all of these tech parks. All of them fall under a category called REIT, Real Estate Investment Trust. What this means is Embassy is not putting money into this anymore. They raise the funds through REIT. They build a tech park. Whatever is their maintenance, they minus it from the rentals that they get. The remaining amount of the rent, they pay it out to the investors. So it's technically like fractional ownership, more or less. Okay. The challenge in REIT is real estate in India is very opaque. Okay. So today, Embassy REIT is roughly trading around 400 rupees. But if you look at the capital appreciation, it has been nowhere. It listed around 330, today is still at 400, it went down to 299, 270, then now it's come to 440 or something. Capital appreciation in this has gone nowhere. The rental yield is roughly 6%. And wantingly, they will limit it at 6%. Whatever is beyond or additional, they will show an additional expense or they'll take it in cash. So because real estate is very opaque, REIT is still in a very nascent stage. So it is still a developing thing. So it's too early to get into REIT. The other challenge in REIT is it is not a growth instrument. Okay. They pay out the rent to you on a quarterly basis or an annual basis and things like this. So when the money comes into your bank account, firstly, the capital appreciation is reducing. Second, if it comes to your bank account, we'll end up spending it. We don't reinvest it. Thirdly, if it's coming to your bank account and you're taxable as well, you'll have to pay tax on it. Okay. So these are the major challenges with REIT. It's very new. Just 6 months back, Nexus REIT, which is running our Kormangla forum and everything, malls and everything as well, they also got listed. So REIT is very nascent, too early to get into it as of now. Gold, if you're holding it for a personal use, like for jewelry, it is not an investment. Your own house you live in and the gold and silver that you use for jewelry is not an investment. Because when you buy gold jewelry, you will end up giving 20%, making wastage charges. When you're again going to exchange it, they will again charge you 10-20% as, for the gemstones, they will say there's no value. For melting, they will add another value. So jewelry in gold in jewelry format is never an investment. Use it for your personal use, don't put a value to it. Gold bars and gold coins are good if you have a place to keep it safely. If you're keeping it in the bank account, bank locker, then that is an additional expense. Today, SBI for the large locker is costing 25,000 rupees a year. HDFC, ICICI and all charge 36,000 rupees a year. So that is an additional expense for you to keep gold. If you're keeping it in your own house, well and good, it should be safe. Okay. But then you should also ensure that when you need it, you're able to exchange it for money. Liquidity is very important. You can give it to some jeweler and you can exchange it for gold itself, like jewelry and everything. But if you want to take it back as money, when you are buying it, they'll charge you a 5% fee plus 3% GST. GST is still there even after GST 2.0 reform. And again, when you are selling it, they will again charge you an extra 5%. Because if they have to make anything out of those coins, they have to again get it. Okay. So the best aspect today, if you're keeping gold only for investment, is digital gold. Till 2 years back, SGB was a wonderful product. It was backed by the government. The only challenge in SGB is it was not backed by physical gold. It is sovereign gold bond, which means basically it has been backed by the sovereignty of the country, which means that tomorrow if I'm not able to pay you, I will print money from RBI and pay. That is sovereignty. Okay. So SGB was a great product. On maturity it was tax free, and they were giving you 2.5% as interest every year as well. But now the government realized it's become too expensive. They discontinued SGBs 2 years ago. So there is no more new SGBs coming out. It's only in the secondary market that you can buy. But if you buy in the secondary market, the cost and everything is already there, wherein the person selling it is making money. Okay, for you to buy it, little late now. So the only other option is either through ETF or through mutual funds. So gold is beautifully placed in mutual funds and ETF because it is backed by physical gold. The custodian, when you place an order for gold, ETF or mutual fund, the custodian buys physical gold and keeps it with them under your name. So tomorrow anything happens, it is backed. They will sell it and they will give you the money. So that is a good product that you can get to. But gold, we have seen, always works only as a hedge against equity. So keep it in the portfolio only to give a hedge. Long-term profits, roughly 7-8% is what you can expect out of gold. Now, silver is also a very good product. So in our commodities of the portfolio, we give gold and silver. Silver, the advantage is it has a lot of industrial use. So, in the last 3 years, what you actually see is equity since 2022, 23 till now has given you single digit returns. And in India, in the last 1 year, it's given you 1% return in the last 1 year, not more. But when equity is not performing, gold in the last 1 year has given you 30% return, silver has given 41% return. So works as a hedge. It's good to have it in the portfolio, but don't keep more than your equity portion. Keep it maybe 10-20% of your equity exposure. That's not.
And if it's already gone up this much over just the last year, how do I know that this is?
It will not sustain. It will not sustain.
Yeah.
So, like equity from 2020, 2021 till 2023, it will be roughly 30% every year. Last 2 years, it is balanced out. So the thing is, any instrument that you take, it has a cycle life, and there will be a correction. There are two types of correction. One is price correction, one is time correction. Price correction is when a stock or markets go up and come down. That is price correction. Time correction is it goes up and stays the same level. If it stays the same level, that is a time correction. Okay. So every product, gold we have seen usually has a cycle life of 7-9 years. Equity has 5 to 7 years. Real estate has 10+ years. If you are through in one full cycle, any of these products will not give you a negative return. So I'll talk about risk in that aspect as well. Risk in any of the asset classes is not a loss of principle for us. Okay. Risk is understanding the asset and holding the asset during the bad phase. Now, whether you look at equity, whether you look at gold, they're all bought in units. Okay. You buy units of shares, you buy units of stocks, you buy units of mutual fund schemes, you buy units of gold. Let's say that last year you bought gold roughly around 85,000 rupees last year, March, April, May. Then June, July, when the budget came out, because it was an election year budget, there was a payout expected for the SGB. So government came out and said, I am reducing my export duty on gold from 15% to 6%. Last year, July. Gold fell from 85,000 rupees to 75,000 rupees within a week's time. So people who bought gold, are they in a loss? On paper, yes, notional loss. But as long as they're holding the grams of gold, the units of gold, today gold has crossed 1,05,000 rupees as well for 10 grams. So they are in profit again. So the risk is our inability to hold the asset during a bad phase. If you hold it during a bad phase and complete one cycle, you will never be in loss. You can look at online figures as well, but statistically, even into equity, you're holding any equity for more than 7 years, statistically, it is 0% chance of loss. But it has to be diversified. You cannot buy Ola Electric today and tell in 7 years the share has become 4 rupees, 5 rupees from 50 rupees. That is not diversified. That's not covering your risk. Okay. Have a diversified allocation. Technically, equity has never seen a loss in more than 7 years. Hope that answers the question.
So digital gold is still risky compared to digital.
Digital gold is kind of risky.
It doesn't have a physical backing.
It doesn't have a physical backing. See, now any of these
It's not regulated.
no. If it is regulated, it will fall under ETF only by default again. See, if you're talking about digital gold in all these NBFCs platforms and things like that they're giving out today, last week, so Cred also has started something regarding gold and everything. These products only mimic the price of gold. There is no backing to it. Okay, there's a credit card, I think from Neo or whatever that says, you earn points in gold kind of a thing. All of these are only linked to gold, but there's no physical relationship. It's not backed by gold. If gold goes up by 5%, they'll give you 5%. If gold goes down, they'll give you that much return. But the thing is, when they are mimicking, it doesn't sustain on the longer run. There is going to be some kind of a change in direction wherein gold will keep rising, and because they are not able to keep up, they will start cutting their losses. So buy products, get into only regulated products, don't get into anything unregulated. And in the regulation, make sure it's regulated by SEBI or some big body. So if you're looking at gold, ETFs and mutual funds are the best products today. Unless you're using it for jewelry, then physical is the only option. Are good?
Cool. I just want to
Yes.
say 2 or 3 things before we close. Thank you so much for a wonderful session. I think one of the realizations I had very early on when speaking to you just before I started college was I kept trying to figure out why the end goal of college is how big your placement is, and I kept going around and asking people what you do with money. And funnily enough, nobody had an answer beyond, hey, I want to go out or I want to buy something. And other than that, nobody could join an expense that is more than 20,000-30,000, but everybody wants to earn 10 lakhs, 20 lakhs, 30 lakhs. Right? So out of that curiosity is how we figured, okay, there is something called how to manage my own expense, and then how to figure out how much I can invest, what is the life goal. And now I think because of so many conversations we had together, like even the first time when I met Anesh, I was like, hey, how much money should I have to retire tomorrow? You said 30. I said tomorrow. Because I said I'll start a startup, I'll sell it, I get 24 crores when I'm 22 years old, I don't have to work at all. And we arrived at that number with an Excel sheet calculation. Right? So then I came with all this process of figuring out how money works, how to invest and all that. Consistently, I've always invested actually 70-80% of what I want in the past so many years. Right? And now I see the portfolio looking good, and most people have such conversations. I was asking what's the average age that people get in and start investing. Then when one uncle will start doing it at 35 after they get married and have a kid, then they talk to other uncles and aunties in their office, and that's when they start. And by the time they're close to 40, they come to Anesh and say, please save me. I don't have enough money. So what I realized, that was the first point. The second point is what I realized is so important about this process is even if you figure out that, hey, this is my expense in the month. I want to learn what the hell mutual funds are. I don't know anything, right? I want to know what a gold ETF is, what REITs are, what anything is, right? The amount of time that you can spend now to educate yourself about it is far more valuable than the 10% on your 5,000 rupees investment that you will get. Right? Still, primarily, your primary source of income is going to be the skill set that you have developed in your brain, and that is what is going to earn you a lot of money now. So use your brain more now to learn about how money works. And since my first semester, before my first semester is when I met Anesh, I've almost thought of personal finance as a subject in college and spent like 4 or 5 hours a week for the past so many years. I always have money control on my phone. I've gone through every course on Zerodha Varsity, and it's bigger than your full college syllabus. And I realized that is far more valuable, and that's how I can have lots of interesting conversations about money and finance. So, with that, coming to my third point, I'm incredibly grateful. Thank you so much, Anesh.
My pleasure. I still remember his exact statement in our last meeting as well. Through this journey of his education and all of his side stints, he was able to save more than what he spent on his own education.
Yeah.
So that was a very big thing. When you were talking about retirement, I'll just run back to one thing we have. Of course, when you were saying that, we did some Excel calculations, we did all of these things.
Yeah.
There is, so we have very advanced retirement calculators as well, but let me take one example of a basic retirement calculator. And yeah, this is very basic.
I think the best ways to start off is, hey, 4 to 5 years from now, I want to do a master's or get married.
Yeah.
And if I can just figure out how much money I need for that and what I should do there, then you figure out whatever your kids do and retirement and house and all of that. So in terms of long-term goals, that's the only one you were able to come up with.
Yes.
That made any sense.
Any of you are planning for any further studies right now in 5 years' time or something? Then I can take a live example. Yeah, you are.
I think Varun, Apurva.
I think she's planning.
Yeah.
So for that, I will open this. Yeah. Okay. So roughly, when are you looking to go for further studies?
4 in 4 5 years.
4 5 years. I will take it as 5 years. These are all basic calculators. Today, inflation of education is roughly around 12%. Okay. What kind of a course are you looking for? An MBA in any of the top tier universities abroad? In India. So
40 lakhs is ISB.
Yeah. 40 lakhs. So see, if you want, in terms of inflation of 12%, if you want 40 lakhs in today's value, it's going to be roughly 70.5 lakhs in 5 years' time. Okay. If, return on investment, you have taken 10%, let's say I will 8%, let me take 10%, then your annual contribution should be 10.5 lakhs for the next 5 years. And monthly contribution should be 87,000. Okay, so that you can afford 70 lakhs or today's worth 40 lakh kind of an investment. These are still small numbers. Okay, now let me. You wanted to retire at the age of 30, right? I'll just run the calculator and give you some numbers. But this is a very basic calculator again. He has seen the advanced version of it with hundreds of times.
4 or 5 times now.
So what is your current age? 21. Retirement age 30. Okay. So 9 years.
10 crores you'll need.
So there's something called life expectancy. Okay, life expectancy.
How long you think?
How long you think we will survive? There are 60. How old are your grandparents, if you don't mind me asking?
My granddad is 80.
So with medical advancement, you will live at least 10 years more than that. Sorry for this.
Average 75.
We take an average, but from our grandparents, our parents live 10 years more. From our parents, we live 10 years more on an average. Okay. So they say that anybody born post 2000 will live to 100. Is what is the average today. Okay. So 60 you cannot tell me at all. If you tell me a number below 90, I will tell you.
He will say tomorrow my life insurance.
Your value will depend with so much money if you go.
Okay. Yeah.
90. 90 is reasonable if you ask me. Okay. So technically you are working for 10 years and your retirement is for 60 years. Okay, remember.
Take 70. 70 is like
70 is very uncommon. Modi is 75 now and he has more stress than us.
Take 70. Don't overwhelm.
I will take 70. Okay. Current annual expense, I will not take your current annual expense because today you are working, but in your retirement age, because that is 40 more years, you will have so much free time that you will travel, you will spend more and all of these things. Okay.
Tell me some number.
Tell me some
You want to travel like crazy.
Are you planning?
Basic life.
It might be too early, but I'll plan to get married and all. Yes. Plan to have children. Yes. Okay. So then whatever is your current expense multiplied by at least 5 or 6.
Current expense is a video editing.
If your expense is only 10,000 rupees a month, then multiplied by 10. 1 lakh rupees a month is reasonable. So I'll keep this as 12 lakhs only. Expected growth in expense, I'm keeping it at 8%. Inflation, basically.
Just as current annual expense, you will have
24. Yeah. Makes sense.
24 lakhs is.
Yeah. Okay, because it's school fees, 2-3 children. All of that is Inflation of 8% is reasonable. Yeah. So that means annual expense at retirement age will be 48 lakhs roughly. That is the value of today's 24 lakhs. When you're 30 will be 48 lakhs. Okay, expenses required after retirement, I'll keep it as 100% only. These are for people, especially who are in big MNCs or CEOs and all. They get a driver, they get a car, they get medical cover, life cover, their mobile internet bill, everything taken care of by the big company. So, the expenses after retirement might go up or might fall down. But for you, we're keeping all 24 lakhs, so we'll keep the same.
24 lakhs and also 24 lakhs increases by 8% every year.
Every
keep up with inflation.
Okay. Rate of return on retirement corpus. Okay, so that means post-retirement, what is the kind of return that you want to get? 10% is reasonable. Again, GDP plus inflation conservatively. If you want to go a little extreme, maybe 12%. But we'll keep it at 10% for this calculation. 8% inflation, and inflation adjusted return is basically a real rate of return, which is 2%. So retirement corpus
At age of 30.
yeah, is at the age of 30, if you have 13.4 crores, you're sorted. That should be a target number. But this is a very basic one. Okay. So 13.4 crores is what you should first keep your target. When that number is achieved, we can look at more in-depth numbers as well.
Divide 13.4.
So 13.4. So your monthly annual savings required is roughly 1 crore, 98,57,000. So monthly, if you're saving today 7.7 lakhs a month for the next 9 years, then you are sorted for till the age of 70. But the most important thing to remember is if you outlive 70, you're out of money. That is very point. Keep that in your mind. The day on your 70th birthday. If you outlive that, it's a challenge. So we need to run different scenarios. So that's where we have another thing called Monte Carlo simulator, where it runs different situations where, if you are at 70, 75, 80, 85, 90, if in case rate of return falls to 6%, 8%, 10%, 12%, where your inflation goes to 4%, 6%, 8%, what are the different numbers? And then you'll come with a range. So we have to be somewhere within the range.
I've done that.
Yeah.
Are these available? Yeah.
These are available. I'm on Wi-Fi itself, right? Okay. So NSE has a beautiful calculator. NSE is the National Stock Exchange. It's
Grow has very good calculators. Just look up.
Grow also has very good ones.
Compound interest calculator. The most
NIS.
difficult to learn is compound interest. You just can't comprehend.
So this website is one of the most basic ones. You just put in all the same numbers what you gave me today, and then you hit calculate. You will get that figure on. AI also can create this for you in less than 5 minutes. Yeah.
Cool. We do one last thing and we close. If all of you can just tell 1 or 2 takeaways from today's session and how your
life has changed.
I have one doubt.
Yeah.
No, that is starting.
Oh, he left the meeting.
I got disconnected actually. I'll just join now.
Hello.
Yeah, sorry, I got disconnected.
Cool. We'll start with Amit.
No, somebody had a question.
Oh, okay.
You're muted.
Yeah.
Yeah, please go ahead.
Yeah, what is your view on quantitative trading?
Quant trading, you mean like you want to design an algorithm that will trade on your behalf?
Yeah, but yeah.
If you have such a model which is consistently profitable, then great. The only success story has been with Jane Street. So if you recently read about Jane Street, in the last quarter, they made $10 billion profit. So apparently 2 guys in some university created an algorithm that does long and short trading on a country-wise basis. And they ran that simulation in South Korea, they ran it in China, and now they've moved it to India. And in the last quarter, they have made $10 billion. So if you're able to come up with an algorithm or something that is going to be evergreen, because it has to look at not only quantitative data, it has to look at qualitative data as well. Like I said, all of these AMCs that have quant funds runs purely on machine, runs purely on AI and the coding that they have done and everything to understand different factors of a company. But as I told you, in an IT company, the numbers are great, the reserves are great, the PE ratios are great, so they will end up buying it. But no active fund manager today is buying an IT company because they know in the future it's very uncertain. And companies in India are definitely not adapting to AI, ML and all of these things. So if you're able to build in some technology that looks at quantitative, qualitative, has a forecasting methodology as well, and that look at different mutual funds as well to see what they're buying and selling, to analyze why they have ignored a sector or why they have gone into a sector. It'll be great. You can run it and then let me also know.
Because I've seen stories where, like, even if you don't join such an IT, then you can run it on your own
You
personal
can definitely
portfolio
learn
and
it. You can definitely try it. In fact, if you are very active on Reddit in India investments and all of these things, there are people who are running algo trades today.
yeah.
But the thing is that will run for 2 months, that will run for 3 months, and then the market changes. A lot of macro factors changes. So their own code will be outdated within a couple of months.
Correct.
So you will have to again then redevelop it. You have to look at what numbers went wrong. And if you're given it complete freedom, now today you have a website called Screener. If you're into trading, you will definitely know about the website. Okay, in Screener, every listed stock details has been given out, all of their con calls, all of their ratios, every number that's available regarding a company, what they do, everything is available. In that, you have an option to put your own screens. So you can identify a list of companies where, the P ratio is this, the ROE ratio is this, the leverage is this much, the return on the profits are this much, the sales are this much, the increase in sales are this much, and it'll throw you a list of 50 companies, 20 companies that you should buy. And you can run the screener on a daily basis. It will send you an email also automatically saying these are the companies that have exited your screen and these are the companies that have been newly entered into your screen as well. So it's publicly available today, but the thing is, it's very difficult for it to run more than 2-3 months where it is adapting to the change in the market.
Yeah.
Now, recently, one of the biggest companies that has given more than 2,000, 3,000% return is something called Cian Agro, CIAN. Not a stock representation. Okay. So Cian Agro is the 1,354th rank-wise listed company in India based on market value. Okay. Last year, their revenue was 17 crores. This year, it is 510 crores. Exactly. So the board of director on that is Nitin Gadkari's son, and they are into ethanol blending. They own 17 farmlands which create sugarcane, and they are giving ethanol to all of these petroleum companies. So in one company, their stock went up in 1 year. Their stock went up from 40 rupees to an upward freeze of 960 rupees as of yesterday, and going up 5% every year. Will you buy it or not? If you ask me, I will not buy it because it is a pure pump and dump scheme. They will pump it up as much as possible. The Gadkari family owns 85% of the stock. The moment the valuations becomes very high, the family will dump at least 40-50% of the stock. They will book their profit. They will start a new company, and they will shift all of their ethanol into a new company. Quant analysis and all of these are throwing out these companies to buy. Personally, on qualitative basis and knowing that it is owned by a government, I will not buy it.
Okay,
So these are things, if AI is able to catch, you can make money during the pump, but you should be ready for the dump.
Yeah.
Rahul, I tell you, related to data support, what I find interesting is we can make a quant sort of trading algorithm for what we're doing in e-commerce. What price to buy, what to sell, what trends to look out for. And we have all the data points.
We have all the data. In fact, there are so many Chrome extensions and things that are available where if you're doing shopping, they will give you coupon codes. They will tell you if some other site is selling the same item for cheaper. All of this, it's
like a crazy data science.
And with the team you have, any idea, if you are able to put it into a proper execution, it is something that can monetarily be beneficial as well, personally and professionally.
Interesting.
Yeah.
Yeah.
Cool.
Yes.
Great. Okay. Firstly, I think a lot of the conversation, whatever you spoke today, was honestly really overwhelming because I am not educated enough to be a part of a conversation about this topic. So, as I think
I have like a lot of ambitious goals. And
I got
think
it.
put me in a perspective of, well, I need to start getting educated about, because it's all over the place for me. Okay. So, yeah, thank you.
No worries. Happy to. Yeah.
Yeah, fair enough.
So yeah, like the power of compounding was something that's been told to me many times, but today I feel like I want to actually see how important that is. And yeah, like the pyramid that you showed also, that was like, and I also know the difference between a nominee and what you need to write the will. So I thought the nominee always just gets all the money after you, like, yeah, something happens.
Thank you. Glad that you learned that.
Yeah.
Important.
All the information is new. So much information.
Even though we've been best friends for all the 5 years.
Never thought about it. Good information, prior television is as far as it's feasible. Now, there is a very structured plan as to what I should do. Get insurance, get a fund, invest. So, educate yourself.
Yes, very important.
It really put me into like perspective as to what I should be doing to reach where I want to be, even 3 years down the line, 5 years down the line. Because yeah, these are all very real goals, and we don't actively think and work towards it. 5 years will just pass, and then I don't think I would ever move the needle closer to being, able to independently achieve all of these goals. So thanks for that.
Happy to.
Like for me, the planning is something that would be important because I do invest, but I invest just without a plan. And since it's all small expenses, I'm like, it's fine. I don't track this. It'll be 100 to 100 rupees. But I think the session really showed me the importance of how like having a systematic plan, what to reach, when to reach it. That would really help me. And I really want to look into that. Yes.
On that note, I just add, if you all have a lot of UPI spends, keep in a separate account. Your transfer. I have a Kotak account just for UPI, wherein every month I put in 20,000, and I know that's only for like small things, grocery, the things like that.
Suddenly UPI will become so high.
Exactly. Otherwise, you will never know where the money salary comes in. UPI goes out. You are like, I have no clue where the money is going, where it's going. So on that note, yeah, you should definitely track it.
So yeah, on my end, it was all like, I set aside so much percentage, I just transferred to my parents' account.
How do we manage the income tax? We get more income from
No. So
give
gift in India, yeah. Any transfers within the family are related to speak. So that's not.
I transferred to another account in my
Yes.
name, and then he handles that. But after the session, I had basic understanding of a lot of things, but he keeps emphasizing that I need to learn more.
I was about to say that.
But
You need to know where your money is. You are working for it.
That is a CFO of a company.
Oh, wonderful. Then no better way to learn it. You should sit with him at least once or twice a week and understand when you transfer the money, where it's going, what it's happening. Ask him knowledgeable questions. What is the return, where, why, so that you can start learning and managing it on your own.
Yeah, like even yesterday night, he was talking a lot about how the market's not being very stable.
Yes.
And he kept talking about hedging and stuff. I was like, oh.
I trusted
Even after that, he kept emphasizing, I can just build a roadmap for you, but you need to continue.
Exactly. Very nice.
I do have to learn a lot.
The machine will not learn.
Yeah, for me,
Come. Hey!
New face.
Anish. Oh, you're doing a mutual fund.
Yes.
Yeah. Vishnu also does this. Yeah. Just we're closing now.
Yeah. We're just understanding what everybody learned. After him, it's your turn.
yeah, so I was saying, I was like aware of all the terms and
He's a finance background. He's only non-technical.
Oh, okay.
It's CFP level 1.
Excellent. Great. Trying for level 2?
yeah, no, okay.
No.
Yeah, that's my dad and my mom.
And how are you?
Good.
So master class is going on.
Yes. Great to see you here.
Prashant had not seen the
Yeah, my dad is coming for the first
Oh,
time.
is it?
You visited
Oh,
before.
wow. If I knew, I would have come with him then.
So it's done or?
Done.
Finish.
Yeah, I was saying I knew all the terms, but then asset allocation and things like regulated, unregulated, what proportion is going where. I think, and to keep a tab of all those and working backwards from my like future goals. Those are some things to work on.
Excellent.
Yes.
Yeah. Anything from the online?
Online. Rahul, Surya, Vidya.
Yeah, like I like the way how he explained why we have to do it. Like I hear a lot of people do savings, but we don't know the meaning why. I like the way he explained it. Nice. Still have to learn a lot when it comes to personal finance.
One step at a time. Yes.
Yep.
Thank you. Thank you. Yeah. Thank you everyone for your time. It's been wonderful. There's some cards out. If you have any questions.
Plus, we have one small sweet thing that we want to give you. It's a box of sweets.
Thank you. Thank you guys. Thank you so much. Thank you for this amazing opportunity. Great to meet such young, amazing minds. Had a wonderful time. You can always reach out to me for any question. Yeah. And thanks to them as well. Thanks to such a wonderful person who's always been very supportive and great.
Cool. Nicholas, click some pictures and
Yeah.
so
By the way, Saturday is the most busy day for them because that's when all the software people are free. So all their clients visit them on Saturday and we came on a Saturday. So
A lot of them are traveling since it's a long weekend.
oh okay.
Yeah, so yesterday was the so it's a government state government.
Okay, we'll all stand here in this back.